Hi, Mike Coe here, joining you from Park City, Utah. Once again, CNBC continues to cover the Winter Olympics in Beijing. With me, Carter Worth from New York City. Today was an interesting day. We obviously got a very big bounce off of the Fed minutes, but I think it's important to remember that although we did see a sharp rally, that was off of some pretty steep declines. And under the best of circumstances, I could say we are flat to modestly lower across most of the board as we take a look at things. Now, there are some areas of the market that had been winners for a while, and despite the fact that the street still really likes them, the price action is weak. And one of the names that we were taking a look at today, IHI, this is the medical device maker ETF. This is an area where the top 5 constituent stocks represent about 50%. The top of those is Thermo Scientific, the largest constituent, very well liked by the street. And yet this thing has not behaved very well. Carter, what do we think is going on here?
Well, it's probably twofold. It's a story about growth in general being under pressure, and then also high flyers in any area of the market, regardless of being growth or not. We've certainly seen give back. So let's look at the charts and try to figure out what we have here is the ETF depicted from the COVID low or just prior, and then the huge advance, right? More than a double, but faltering. You see the double top formation. Now, another way to draw the lines is simply to put in your 150-day moving average, which is a way to measure trend. And it, you'll see there, is now flattening and starting to roll over. Now, if we take this and look at a longer term chart, here's the same thing with the 150-day. And what's important here is one could say, well, why is it any different than it was on the COVID low? It bounced from there. But here's the thing. That was COVID related. This doesn't have that excuse, if you will. And now then the next two charts. Look at the comparative chart of this ETF, which is devices, a growth area of healthcare, versus the healthcare sector itself. So two colors, yellow for the ETF, pink for the overall healthcare sector, which, to be fair, has big weightings in things like Lilly and Pfizer and J&J. But the outperformance on a 5-year basis is pretty extreme. And then finally, if we look at the 10-year, 15-year comparative chart, it's, I would just say, a little much of, too good. Take profits, write calls, do something.
Yeah, I mean, one of the things that we definitely saw here was a lot of put activity. And this was not the first time we saw it. Actually, this was part of a large roll. Somebody had actually initiated a bearish position in this some time ago, and they're just adjusting their positions down to lower strikes now. And I think one of the things that's important to remember is that you can have great companies, they can be doing great things, and they can start to trade at relatively great valuations. And we've seen a lot of very good companies with relatively lofty valuations, essentially seeing some pullbacks. As you see people pulling back from growth, it's going to be some of these names to start to feel the pain. Okay, so there's another stock. You know, we were talking yesterday about some stocks that were starting to essentially seem so bad that they might be getting good and we're looking very cheap. You know, we've had some pretty good retail numbers this earnings season, and yet we have at least one retailer where the performance is not looking so great. I'm talking now about Big Lots. This is a name that is trading at single-digit multiples, and yet we continue to see people pressing bearish bets. This traded 7 times the average daily put volume today. That despite the fact that this thing could be trading down to single-digit earnings multiples. If you consider that this is a name that's expected when they report the first week of March, I believe, is going to be to earn about $5.50 a share. Clearly, this heavily indebted name is something that people don't feel that good about going forward. What are you seeing in the charts?
Well, it's interesting. We're starting to sort of separate winners from losers. You'll note that like Urban Outfitters or Gap, all at 52-week lows. And that is the case here with Big Lots. Now, first, this is a 5-year chart, and there are no judgments, no annotations, no lines drawn. If we look at the next chart, you'll see that it's very clearly in bull and bear phases. So the 2017 to 2019 move from 70 to 10, and then of course a bull phase from 10 to 70, and then a new bear phase. Now, if we go back and forth, let's toggle. The prior chart, we have trend lines measuring trend. You break above, you're in a new bull phase, you break below. Now, another way to do that automatically is to use the 150-day moving average, which you'll see here, the blue smoothing mechanism. So let's put them both together. That's the point. We can draw trend lines, or we can try to use a moving average to measure trend. But either way, we're clearly in a downtrend. And now the final chart, this is what my eye sees, a well-defined head and shoulders. We've just now undercut the neckline, and there's every risk that it continues lower.
Yeah, this is a name, I think it should be said for people who are looking at it. You can take a look at the valuation on an earnings per share basis, but it's important to remember that this company is actually more debt than equity. And that is one of the situations where you're going to sometimes see people using put options that would otherwise look quite expensive. And that is because, of course, if things really go south, it's going to be the equity holders that get wiped out first, and puts serve as a form of insurance, which actually brings us to our next stock, which is an insurer. I'm talking now about Chubb's, which actually saw a very different type of activity. Here we saw a really large sale of the March, it was the May 230s. We put the March there, but it was actually the May 230 calls. We saw 2,200 of those sold for about $2. Now that trade is very likely a covered right, which means that somebody is looking to collect a little bit of premium against a large share position. In this case, they would be essentially giving themselves 1% of the current stock price and additional premium over the course of the next 3 months. And this still gives them substantial upside from the just under $205 a share closing price that we saw today. So they'd have to get all the way to 230 and beyond before they'd be sacrificing any gains. And that would be more than a 13% rally over the course of the next few months from here. Carter, what are the charts indicating?
Well, sometimes less is more. I've got one chart. Now, that's a trend line, and this stock is checked back to trend, which is to say it's had nice corrections, dips, drawdowns, sell-offs, from which it bounces repeatedly. It's north by northeast, higher, steadily higher, never gets extended. The arrow would suggest that that's at least what I see, more of the same, a classic stay long, be long.
And, on top of this is a situation, I think, where the technicals also might support the options trade that we're talking about here, because when you do a covered right, essentially what you're doing is you're making a moderately bullish bet. You're picking some level that you don't think it's going to exceed. In this case, the trader is choosing those May 230 calls. So we're talking about a nearly 14% higher strike price plus the premium than where the stock price is here. Do you think they chose that strike wisely? I mean, that trend that we're looking at looks like it's fairly orderly.
Yes, I mean that sometimes these things sort of dovetail perfectly, and that's what the implications are here.
All right. Well, Carter, thanks once again. Thank you, everybody, for joining us. Be sure to hit that like button. Send us a tweet if you have a question. Now, we are going to try to answer some viewer questions during this segment tomorrow. So if you have some questions, you might want to send them to us right now. Thanks very much. Carter?
That's right. And if you want an alert when we post our next video, of course, subscribe and hit the notification bell.